Hello, Maverick Traders. This is Rob Reinhold. I'm joined by our CEO, Darren Fisher. Let's go ahead and get into last week's news. And boy, last week was a wild, wild week. Now, we called last week that we thought we were going to get a bounce. And we actually gave this week a +2. And I got to say, we looked pretty smart on Monday and Tuesday. And then the market decided, you know what? I'm not going to listen to these guys. I'm not going to listen to anyone. And the market got absolutely crushed on Wednesday. NASDAQ down like 4.7% in one day. S&P down 3.5%. It was just got crushed. And then we got Thursday where we had a rally and then we lost it all by the end of the day. Looked very bad. And on Friday, we came down and pierced through the prior lows on large volume. And then we had a huge rally, like a huge 2 or 3% rally in the last hour of trading, to where we actually now are no longer below the prior day's low. So this is the 7th consecutive down week. And this week, the market officially went into bear market territory. Now, it's not going to be a bear market in the books because it has to be a closing of the SPX. So the SPX has to go lower than the low on today, on Friday, for it to be considered a technical bear market. But at one point, we were down 20%. NASDAQ's down close to 30%. So when you take a look at these numbers, and then you take a look at historical numbers, you have to start to think that we're getting closer to the bottom. Now, was that the bottom? We don't know. Who knows? Again, we said last week that we thought we were getting really close to a bottom. And the market said, hey, hold my beer. I got one more down move for you. And so we have to, again, take a look at numbers. If the economy doesn't go into recession, this is typically about where bear markets stop going lower. If the economy does go into recession, there's definitely more downside. So the average recession brings a 36% decline in the S&P 500. That's the numbers. So you can see we're not even close to the bottom there. Darren and I actually, right before this, had a quite, I don't want to say spirited because it was not spirited, but we had quite a discussion about recession. And Darren, let's revisit that real quick. I said, yes, I think we're in a bear market, but no, I don't think we're in recession. So make your case.
Yeah, in my case, I think we do go into recession. There's a couple of things that are out there. One is the performance of the consumer industry. That has been beaten down so hard. So somewhere, some analysts, some collection of analysts out there are seeing things that maybe aren't bubbling up through right now, and they are trying to get ahead of this and know that we're going to have issues moving on. And we talked about where's the catalyst. Well, I don't know where there's going to be a catalyst, but I think that the biggest catalyst on the horizon is this year's wheat harvest. India is no longer exporting wheat. Everything that they produce for themselves is going to be for domestic consumption. I don't have the exact numbers here, but the Ukraine, I think, produces about a quarter of the world's exportable wheat. Give me some leeway on that, and about a similar amount of barley. With the transportation issues right now, their silos are still full from their last crop. They can't get their last crop out of their silos. So anything that's coming up right now, unless they can get their silos empty, anything that's in the field right now, if they can't harvest, it's going to rot in the field. And then they're not going to be able to replant in the next growing season. So if there is some sort of catalyst, I think it's going to be this year's wheat harvest. And I mean, that puts it not only in a domestic recession, but potentially more realistically, a global recession as well. So, there's no data to back this up. This is just gut feeling, reading the tea leaves, what's on the horizon. So I think I give it a 75, 80% chance we do go into recession.
Thanks, Darren. And if you take a look at the economic reports, the Empire Manufacturing and Philly Fed, really negative. And so these are regional manufacturing numbers. And these are the earliest numbers we get for orders coming into manufacturers. So, for example, let's say that there is a company that sells a lot of things in the fall. Well, they're placing their orders now. and they're placing their orders with the manufacturers. And that's what these things are measuring. And when Empire Manufacturing is supposed to come out at plus 10-ish, and ends down 11, and Philly Fed is supposed to come in at 18 and comes down 2, this is really a sign. And we always look at these at Maverick. These regional manufacturing numbers are the first things to turn. So, Darren, these numbers are absolutely supporting your argument. We got retail sales were pretty good, but we did get Target and Walmart lower estimates. Costco got crushed. Again, a lot of pain in the retail sector. Ross Stores down like 27%. And then we've got leading economic indicators down 0.3%. So since Darren, I gave you a little chance, I'm going to make my quick case here. I think we don't hit the technical definition of recession, but I don't think there's any growth. I don't think there's any growth at all. Now, where does the market go if it's not technically a recession, but it's not growth? Is it down 20, 25%? I don't know. But I think we get through this. I just don't see a case where people lose their jobs. And that's really what happens in a recession is people lose their income, lose their jobs. And I just think the job market is too strong for that. So let's stop talking cocktail talk here, Darren, of what our opinions are, because guess what? We're just a couple dumb dudes trying to figure this out. So let's just look at the charts, huh? That's a much better idea. So this week, Dow, S&P down 3%, NASDAQ down 4.5%. Just an ugly week. Let's take a look at the charts. Now, this is actually one of my favorite patterns to buy. Now, look, I am a trend trader through and through. I'm on the trend, follow the trend. But there is a counter trend trade that I will take. And now I usually do this on a more intraday basis, like a day trade or a multi-day swing trade. But I love when something has come down, hit support, and then breaks through that support, and then recovers. Now, I'm going to talk, we call it third order trading here at Maverick. We talk about poker. We talk about, when you're third order, it means you were looking at the bluff. You're looking at, where's the best place to go? Where's the advantage here? And imagine that you have this market that everyone was panicking. Everyone was panicking when it broke. When this last low broke, people were saying, you know what, get me out, throw in the towel. And then by the end of the day, people came in. So a lot of shorts were covering, and people came in to get long. And this is actually one of my favorite little counter trend trades. Now, look, I'm not saying that this is a new uptrend, but I do like it when we pierce through support and then recover it quite quickly. That to me is a good little sign that, this last push pushed out all the last people and triggered all the last stops. And once they were done, everyone's exhausted. It's time to go the other way. Now, look, there's nothing in this chart right here, right now, other than two kind of reversal candles. That's it. There is no reason to go wildly out there buying on Monday. There just isn't. If we can get a decent candle on Monday, okay. Then I think you can start to look at this as a tradable bottom. But the question is, where's it going? SPY up to 410. Okay, that's a decent run. That's a 15-point run. That's 4.5%. Okay, it's possible, but I think that's our next level of resistance. We take a look at the NASDAQ. The NASDAQ candle looks a little bit better. The fact that it's more of a hammer candle. But again, we've got two reversal candles down here at support. We got the pierce. So the question is, if it does bounce, where's it going to bounce up to? 310 on the Qs. So as you can see, we are definitely not bearish here, but we're also definitely not bullish. So I know it's a really chicken you-know-what place to be. But look, this is where we are. Last week, we got to a VIX of 34. We said, hey, that probably was a capitulation bottom. The market said, no, not yet. On Friday, did we make a capitulation bottom? And we'll know at the beginning of next week. If we get a big green candle and there's tons of buying, then I'm going to say, yes, that is a tradable bottom right there. You can see we did not get a higher spike in the VIX on that big down move. So it tells us that, okay, volatility's come up, it peaked, we're likely to come down from here. So I've got this week, very possible Friday was the bottom. I should not say the bottom. Let's cross that out. Bottom. There we go. I am definitely not brave enough to call the bottom here. I am brave enough to call a bottom here, but we'll see. Now remember, this happened on monthly options expiration day. A lot of things are driven by options. And as the market kept going lower, the way market makers square off their position is they short stock against their puts that they've sold. So they sell a bunch of puts, and as the market goes lower, they have to sell and sell more stock, pushing the market lower. Once all these options came off or were coming off, the market makers have to unwind all of their hedges. And so that's probably why we saw that big jump at the end, was that it was really tied to monthly options expiration. We saw a big volume reversal in there. But look, we're still in a bear market. We need some confirmation. And look, regardless of how big, if this bounce happens or doesn't, we think it's going to be mild, and we think it's going to be just another wave in this bear market. Anything you want to add, Darren?
No, I mean, I think that's it. I mean, if you looked at the intraday chart on Friday, if you were watching the markets on Friday, you could see that it was looking ugly. It was only about the last 2 hours that things looked, that the bulls really came in, and it was hard, it was sharp. It was, I think anyone who was short took that opportunity and says, okay, I'm not going to hold over the weekend. There's no upside for me to hold short over the weekend. Let's just go to cash and get out. I think that's a lot of it was. When we talk about our market outlook, I think we do get a rip your face off to the upside rally, but I still, and this is just cocktail talk, that's my gut talking, I think it's fast, and I think it fizzles very quickly and rolls back over. That's, like I said, there's nothing scientific about this, completely a gut feeling.
Thanks, Darren. So let's give this a score. Our scoring system says this is a -3 market. We've been at -3 since, where is this? April, middle of April. We've been at -3 there, meaning this is the most bearish that we could possibly get. We have to stay there. Again, we're technical traders. So it's saying, okay, this market is still a bear market. But the question is, in the short term, what do we think is likely to happen? And Darren called for a rip your face off rally. I'll agree. I'll agree with that. The big question is, how long does it last and where does it go to? And is it just going to be like we saw last week, where we got 4 days? Look, this was a rip your face off rally. This was like 4.5%. It could absolutely be that. So look, we don't like entering new short positions here. And if you're going to enter some long positions, make them all short term, because we think this is simply just a tradable bottom in a bear market. And so we've got a 0 for the weekly outlook, but really we talked about this being more of a +2 at the first part of the week and a -2 at the end of the week, where we probably rally Monday, Tuesday, Wednesday, and then maybe fade on Thursday and have a down Friday. Very possible. Anything to add to that, Darren?
Nope, that encompasses, I think, the general feeling of where I'm at right now, and I think we've seen this in the past. We're going to have some very sharp market action, and we'll just wait to see where it goes. On that, let's take a little look at the sectors here, and the sectors are really interesting. Now, again, I'm having to caveat this for a lot of the past weeks. Our outlooks that you're going to see are predicated on the fact that we do get a short-term bounce. So take that into consideration. But you can see this is last week's performance. Consumer down almost 8% in a week. I mean, consumer's been being beaten down. It continues to be beaten down. And there's a lot out there that some internal analysts are seeing that the word is not percolating up to CNBC, to Fox Business, to the media, but I think a lot of internal things, a lot of close to the vest analysis says consumer is in for a hurting time. Industrials and tech both down 3.5%. That's not surprising. They've been going down there as well. The surprise for me was a little bit of healthcare. I was really surprised that healthcare didn't follow with the other stuff. And you can see energy, top performer. It's been the top performer for a major part of this year and last. Everything else is just kind of down about 2%. So I think the leaders to the upside is going to remain energy, and I think we do look for consumer to continue to lead us down, followed by tech and industrials. So let's look at the individual sectors here, starting with utilities. And you can see, utilities, it eked out a little bit of a gain. I'm at a zero. It looks to me like it's in a base between 70 and 73, and I just think we hold out there. And it just goes, and we're starting at the upper end. I see this going sideways. Utilities wants to know what's, you've got a couple of things going for it. They're a proxy for bonds because they largely pay a dividend, but so that's attractive to a lot of people right there. But then in a rising interest rate environment, the value of that dividend is eaten into. And so you've got two competing forces right here. I think it's going to take utilities a little bit of time to decide which way they want to go, up or down. Taking a look at communication services, again, predicated on a bounce. You see that long lower shadow on Friday. There are a lot, buyers came in right there at they've established support at that, 56.50 area right there, and that's where they want to have it. And so right now, I think they're spent. This just feels a little bit spent to me. I give communication services been -2, -3 for the longest time. I think we're at a zero on communication services for the foreseeable future. I think this tries to establish that support level, and it's going to take a couple of weeks. And once that support level is firmly established, I think then you have an opportunity to possibly go long on some communication services parts if that support level is not broken. Real estate held out decently. I like the candle that we saw on Thursday and Friday, so I'm at a +1. This one's looking pretty good. I think you've got a little bit of the upside. You could go up up to that 43 level quite easily right there. I think 44 is another possible target. Up there, close to the 20-period moving average. Any of that, I think it's going to be slow and sedate. Again, I think it needs to put in that base, put in that support, and have something to build on from there. Mildly bullish on real estate right now. Industrials, that's another one. You can see the long lower shadow. It has been beaten down. I think we do get a +1. I think it comes up there, and that's just my gut feeling of where we go. We've got a lot. We could go from where we're at right now at 91 all the way up to 94, and I wouldn't even blink an eye. I think that's probably a pretty good target right up there. There might be a little bit more, but I think we take a couple of weeks to get up to that point. That's where we're at on industrials right there. Looking at healthcare, with the fact that it eked out a gain, if we do get that bounce that we're expecting, I'm at a +2. I think for this market to be able to pull out a gain, for the sector to be able to pull out a gain in the week that we had, we're well off the lows that we established last week. There's some strength to this. And so remember, even in a down market, the stuff that can hold in there or even make gains, that's your strongest stuff, and that's where you're going to see your best gains when the market does turn even temporarily bullish. So I'm at a +2 on healthcare right there. Financials. Not a lot of faith in financials right now. This is one that I'm just looking at it. I think we're a zero. You could make me the case for a +1, but I think we base here between that 33 and 34 level. And again, we just need to put in some support. Financials has been taking a serious hit for the past 2 months, and I think it needs some time to take a breather, firmly establish support. I'm talking like 2 weeks, 3 weeks of support before we can even take a look at financials making it to the upside, and that's assuming that the market doesn't fall down before that. And we've got consumer coming up next. The fact that this is beaten down so much, I'm in a -1. I think we've got some downside. we still closed below the lows of last week. Even with that lower shadow, we still couldn't get into any type of territory that was above that support level. And when I say support level, think of a support band. I just think we're clearly below that support band right there. And I think we've got a little bit more downside to go to. We might get an up day once or twice, but then I think it's going to be pretty anemic. And I think we do have some room to the downside on consumer right there. Tech is another one that I think is going to be a zero. Yeah, you had a lot of, again, we're looking at Thursday and Friday right there. We're trying to put in that support right there. I just think that, this has come so far. I mean, do we drift up a little bit? Quite possibly. I think we go up and then we turn back over a little bit. Anything we get is going to be pretty anemic. Tech has been one of the ones where people, it's no longer sell what you want, it's sell what you have to. So there's funds out there that have multi-year gains on some of their tech holdings that have finally said, we need to preserve capital, and that's where they're getting some of them, some of that right there. Looking at basic materials, actually, I like the way basic materials held in. I mean, we did have a little bit of a down day, but you see we're only down 0.24% on Friday, and we're at higher lows, not quite making the higher highs yet, but I'm going to give materials a +1. I think it's got some movement to the upside. It's one of the closest ones to that 20-period moving average, which is going to be one of the first benchmarks that it has to regain in order to be bullish. And we might look at this and just say that we were in a 10-point channel, basing channel for 4 months during this period, from that 80 level up to that 90 level, and this just might be noise. But in the short to midterm, I'm actually pretty bullish on materials. Looking at energy, we've had energy bullish throughout this whole debacle, and again, we're at a +2. Eked out a good gain for the week, highest performing sector for the week, and we're above the 20 and the 50. This is one of the only sectors I can truly technically look at and say, yes, this is a true +2 here. I think that energy keeps getting rewarded right there. So to stack everything up, on the low end there is consumer. At a 0, we've got tech, communication services, financials, and utilities, a really odd mix of things that we think are going to be 0, but this is the market that we're in. Mildly bullish at a +1, materials, industrials, and real estate, and we're expecting the most action the next week in healthcare and energy. So looking at a couple of potential trades. So last week in utilities, we were long NRG. And energy performed very well for us. Energy was up 8.11%. So we're happy to be long that. This week we're looking at AEP, American Electric Power, and this is a really long-term bull flag. And this is about a month-and-a-half bull flag right here, where it's just in this little channel, and it looks like we want to pop above that trend line right there. And we've not seen any real down selling. We're right at the 20. We're right at the 20 and the 50-period moving average right here. So this is one that I'm quite happy to be long. Now I think any bounce that we have is going to be fairly short-lived. So I'm going to play this anything that I've got to the bull side. I'm going to play a little more conservatively. So I'm going to go out those 100, 105 bull call spread for June. I know we just finished with May. I think with the volatility that we're seeing right here, this is going to be pretty good, and I think 105 is about all you can expect out of this in a down market. Now, last week in communication services, we were long Lumen, L-U-M-N. Didn't perform exactly how we wanted to see Lumen perform. They were down 4.57%, but when you compare it with trades like NRG, hey, you're going to win some, you're going to lose some. It was perfectly acceptable loss, especially if you're in an options trade on Lumen. So this week we're looking at NetEase, and this had a nice little breakout. It's been in that downtrend. You can see the upper trend line from really mid-January to present right there, and it's touched it a couple of times, tried to break out, and this is the 5th time that it's tried to break out of there right now. So I want to see one more day of confirmation. And then if I can get that confirmation, if I can get it on volume, I'm even more happy. But then I mean, that's the trigger right there. So you could go out to the June monthly 95s, and then this next Friday's 100 diagonal shorted against it. I like that that diagonal. Let's test drive it for a little bit. If we do get an up market, I think you're rewarded handily. And if we go sideways, then look, get out of the trade next Friday. But that's what I'd be looking at for right there. In healthcare, last week in healthcare, we were long Merck, MRK. And again, healthcare was doing pretty good. Merck was up 3.47%. Happy to have that one in our portfolio if you made it, if you went and did that trade. This week, we're looking at Medtronic. This is going to be sideways, and sideways and kind of weak. MDT is the ticker on that one. And you can see it's up there. It's in this channel. It's in this range between about the 100 and 106. So we just think it's going to meander out about there. So let's play it sideways. We've been playing a lot more stuff sideways, and you can see that we're going to be doing pretty good. But I like that June 3rd, 9,500 and 105 butterfly right there. Calls or puts doesn't really matter. The risk graph is exactly the same. And you don't have to hold this till June 3rd. If it's pegged at about the 100 level next Friday, look, go ahead and take your profits and run. That's fine right there. So we're playing this a little bit to the downside. And just to see where this goes. But I put it on. If you want to wait until it got a little closer to 100 to get a little more premium on those at-the-money options, that'd be fine as well.
Last week in industrials, we had Expeditors as a long trade, and it was not a long trade. It was more of a short. It was down 5.5% on the week. Look, it's a higher volatility. It's a higher volatility trade, and so when the market got weak, it got weak as well. If you have more time on the trade, you might get a bounce back, but at this point, it's not looking all that great. This week, we've got Stanley Black & Decker in a low base. When you're looking to find shorts in this kind of market, everything's sold out. Everything is probably going to have a bounce if the market bounces. So you need to be really careful entering new shorts here. You have to be really careful and say, okay, number one, what's my time frame? And number two, can I sit through some pain? I mean, that's really the question here. If you're looking to do a real short-term bearish trade, I'd say don't do it. Just sit in cash and wait for this market to bounce and then take a new position. But take a look at this one here. This is all the way out to June. So we could get a bounce this week, even next week. And as long as this thing turns down, this is a very good trade here for the 110, 120 bear call spread. So this is going to bring you in about $5.80 in a credit. That means you got about $4.20 in risk. This is just you're playing this trade saying, hey, you know what? I think you're going down. I don't know when. I don't know what you're going to do over the next week or two. But I do think that if I wait, you will be below 110. And this is the trade. Make $5.80, risk $4.20 on the trade. In financials, we had FBP sideways, and it was a great call. We had that for the May expiration, and it basically closed at 1361. We did the 14 butterfly. So ironically, when I was out there looking for sideways in financials, I came across this one. It came up on my scan. Now look, we always talk with our traders, don't have a watch list. Don't follow the same stocks, because what happens is when you follow the same stocks, you start to say stuff to yourself like, well, I know this one and I made money on it last time, or I lost money on it last time, so I need to get my money back from it. Those are all dumb reasons to make a trade on a symbol. There are thousands of symbols out there. Your job is to find the best symbol today, not the symbol you like, not because you like them, because you have a Tesla. Sorry, everyone. All of you are like, hey, I traded Tesla this week and I have a Tesla. Yeah, you probably traded it because of that reason, not because it was a good trade. And so at Maverick, we always talk about getting to every trade totally fresh, like you've never traded it before. So when I looked out there, looked at, okay, what do I want to trade? I want to be sideways in financials. This was still the best one. So this one's going to be a little bit longer term. Last week we had the 13, 14, 15. But since we need to go out to June, I've got to widen that out. It's going to be the 12, 14, 16. So you can see here, this is actually mildly bullish here on FBP, but still sideways ultimately.
And a consumer, last week we had International Paper IP again sideways. Another good call on that one. IP was down 0.65%. You're never going to be able to get rid of a butterfly right at the middle strike price. So within a percent or two, we're completely happy with International Paper sideways. We're happy with that. This week, though, we're looking at Foot Locker. We're going to call this first stage uptrend. And you can see there was some news event, whatever, knocked the stock down, and it just based. And it's a huge gap right there. And it looks like that it wants to break out. Now, this is going to be one, I want to see another up candle to confirm this. This is looking like the right one, but you've got that huge profit area of a gap that has not been filled. That 30, I think it's the 30 level, is probably one of the best, your best first target right there. 38, excuse me. That you've got an unfilled gap right there that is just begging for people to come in and get into. So I want to see one more day for this to confirm, but how do you want to play this? There's something like this. I'm going to go out to June, buy the 30 calls, and I'm going to short this Friday's 33s, and we're going to let this one run. This is not something that's going to get up to that 38 level in a week. Now, this is going to take a little bit of time. So just test drive it for a week, see if it goes. If you want to call the long calls or maybe, short the 35s or the 36s against it next week, perfectly viable trade. This is one that's going to take a full month to go out there. But I think, you could definitely sit through some volatility in this one. Last week in tech, we had Western Digital long. That one, it wasn't a blowout. Western Digital was down 0.9%. So if you got some time and you're still in the trade, it shows some possibilities of bouncing back. And if you don't, look, just book the loss and move on with a clear head. This week, we're looking at SHLS, Shoals Tech, and it's just some bullish action. You can see, despite nobody told Shoals that the market was supposed to be volatile this week. No one was supposed to see the candle that we had on Tuesday, and Shoals didn't care. They just said, we're on our own thing. We're slowly making newer highs, and we're in an uptrend on the upper highs right there. This one says that this is a secular trade right here, that Shoals doesn't care what the rest of the market does. People want to stay in this. So I'm looking out to July. Those July 1250s, short the June 1750s. I mean, that's a 2-month diagonal spread for us, and you very rarely see us do it. But if you can do it, I think it's the place to go. You could definitely be up in that area, within a month, up to that 1750 area, and then decide what you want to do with it.
In the materials sector, we had Olin Chemicals long, and it was flat, up 0.08%. So again, as Darren said, if you had a bullish trade on it, if it had some negative theta, you probably took a small loss. If you were more sideways, you probably had a small gain. If you still have more time, I still like the trade quite a bit. And this week, I've got Dow, which is right in the same category as OLN. We've got this high base. One of my favorite things to do in high bases. I love diagonal call spreads. They're one of my favorite strategies because it allows you to get into things in a really wimpy way. As a trader, it's so hard to be looking at a trade, be like, oh my gosh, when should I get in? Should I get in now? Should I wait? What should I do? And this is why I love the diagonal call spread, because they work great in high bases. So again, this one here is a 65.70, just 1 week on the short call. So basically 70 is going to be your top. That's going to be your maximum gain on this. If it goes past 70, well, you'll start to lose a little bit of your gains, but not much. And at some point that flattens out. So as you can see here, this is a nice trade where you can sit and wait. You can get into it. And so let's say that this week it goes nowhere. Let's say at the end of the week it closes exactly where it is, $68. You made money. You made money. This is a theta positive trade. If it moved up to 70, you made the most money. And then on Friday, you had to decide, do I want to keep it or do I want to unwind the whole thing, take my profit, and move on? I love these kind of trades. Last week in energy, we had Valero, and Valero was down 1.3%. So we were long Valero, and it did not do well. Again, 1.3%, it still beat the market underperformed the rest of the energy stocks a little bit, but I still think you have time. Here we've got Petrobras. We've got a ascending triangle pattern. We got a little bull pullback down to the bottom of this triangle. Again, I have no idea when this triangle is going to break out or if it's going to break out. But ascending triangles typically will break out. This is where, if I was just directional trading, saying, okay, I want to buy it and see how high it goes, I would have to look at this 32 area. I would have to look at this 32 area and say, that's resistance. That's the most I can hope for. And at $30.80, there's not enough meat on the bone for me to make this trade. It's not worth it. I just can't do it as a directional trader. But if we go out and we look at diagonal call spreads, all of a sudden, we're looking saying, we can open this up this week. And basically, 32 is our top point. Anything past that, we start to lose a little bit of our gain, but not much. And then down here, our break even is 30. So we're basically saying, hey, as long as this thing stays between 30 and 32, it's going to be a profitable trade this week. And then on Friday, you get to look at the position and say, hey, do I want to hold it? One of my favorite things that happens is, let's say this closes at 31.90, and I say, yes, I want to hold the long calls. My short calls expire, and on Monday, all I own is the 29 calls, and it breaks out and runs to 34. That's a really exciting trade. That's one of my favorite trades that happens with the diagonal call spread. You get in, you wait. On Friday, you say, yeah, I want to take a shot at this next week. Let it go. Let that long call go and take a shot at it and manage it accordingly. Again, that is Petrobras. If you want to take a look at any other trades or share some trades with their traders, please go to the Maverick Trading website, go log into the members area, and jump on the forum and share those trades with other Maverick traders. So let's wrap this up. We called for a short-term bottom last week. Looked smart for 2 days, then looked dumb for 2.5 days, and then looked smart for the last 2 hours of Friday. So I'm going to give us a good solid C-. Good solid C-. We didn't fail, but it wasn't all that great. I have no idea if Friday was the bottom. No idea. But what we are seeing is bottoming action. We're seeing stocks that really got killed actually going up. I mean, take a look at stuff like Roblox. Roblox has been terrible. Peloton has been terrible. They actually had up weeks this week on a down tape. This is bottoming action. And we're just seeing these absolute extreme levels, like 85% of stocks under their 50-day moving averages. That's just a crazy number. Whenever we get to these extremes, we have to say, okay, the hair on the back of your neck goes up. Okay, we're probably close to a bottom. We don't know when it's coming, but we do know we're getting bottoming price action. That being said, it's not a bull market. It's a bear market. These rallies are, as Darren called them, rip your face off rallies. They go higher, they go faster, but then they fade fairly quickly. So if you're going to make bullish trades, keep them short term. Proper position sizing on everything. Thanks for joining us. Everyone have a great weekend. That's the trading room.
Thanks, everyone.